There is a version of this math that nobody in finance content is actually running, and it's costing you somewhere around $40,000, maybe more, depending on how long you've been waiting. And I know that sounds like the kind of claim you've heard before, but stay with me, because I'm going to show you the exact numbers, not a clean hypothetical with a lump sum sitting in a savings account, but the real version. The one where you've got a car payment, a credit card balance, and maybe $500 a month of breathing room if you're lucky. Because that's the comment I keep getting, and honestly, it's a fair one. So here's what this video is about. Most content on this topic gives you a binary. Either pay off your debt first or invest first. And the conventional wisdom, the thing your parents probably believed, the thing that feels responsible, is to get out of debt before you start building wealth. Get the clean slate, then start. But the math on that, when you actually run it, tells a completely different story. And I'm going to show you exactly where the conventional wisdom breaks down, what the actual trade-off looks like in real dollars, and what you should do this paycheck, not someday. I want to cover three things. First, why your car loan and your credit card are not the same problem and should not be treated the same way. Second, the one thing that almost everyone in debt is quietly giving up without realizing it, and what that costs in compounded dollars over 20 years. And third, the actual split. How much goes to debt? How much goes to investing? So you can leave this video with a number, not just a concept. Let's start with the debt itself, because this is where most people get it wrong. Generation X, the 45 to 54 crowd specifically, carries more credit card debt than any other age group in America. Not broke 20-somethings, not retirees. The average balance for this age group is around $7,236, and the average APR on that debt right now is 21.52%. And here's the thing about that number. The S&P 500 has historically returned about 10% a year. So if you're carrying a credit card balance at 21%, every dollar you put into the market instead of toward that debt is a dollar working at 10%, while you're paying 21% guaranteed. That math doesn't work. You cannot invest your way out of 21% interest. That debt needs to go, and it needs to go fast. But here's where it gets interesting, and this is the part most people don't separate out. Your auto loan is a completely different situation. The average used car loan right now is running about 11.26% APR. A new car loan is around 6.37%. So if you financed a new car and you're sitting at 6.37%, the math on whether to pay that off early or invest the extra money is actually genuinely close. Fidelity's research puts the crossover at 6%, meaning if your debt is below 6%, you're almost certainly better off investing the extra money. Above 6%, it starts to favor paying down the debt. Your new car loan is sitting right on that line, so let me show you what the numbers actually say. Say you've got $13,951 left on a car loan at 6.37%, with 48 months remaining and a $330 monthly payment. If you pay it off on schedule, you'll pay about $1,870 in remaining interest. But if instead you take an extra $300 a month and invest it for those same 48 months at an 8% return, which is conservative compared to historical averages, that money grows to about $16,900. You saved $1,870 in interest by paying early, but you gave up $16,900 in investment growth. Investing wins by roughly $15,000. Now I know that feels wrong. It feels wrong because we're wired to hate debt. Seeing a loan balance go to zero feels like progress in a way that a brokerage account going up doesn't, at least not emotionally. But the math doesn't care about how it feels, and if you're in your mid-40s or early 50s, you don't have the luxury of letting the emotional version of this decision cost you $15,000. That said, and this is important, there's something even bigger than the car loan math that most people in debt are completely ignoring. And this is the number that actually changes everything. $24 billion. That's how much an employer 401k match money goes unclaimed every single year in the United States. Not because people don't have 401ks, because they cut their contributions to free up cash for debt payments and they never get the full match. The average employee who misses the full match leaves about $1,336 on the table per year. Compounded over 20 years at 8%, that's roughly $42,855 from 1 year of missing the match. If you've been doing this for several years, you can do that math yourself. Here's how it works in a real example. Say you're earning $70,000 a year and your employer matches 50 cents on every dollar you put in, up to 6% of your salary. To get the full match, you need to contribute $4,200 a year. That's $350 a month. Your employer then adds $2,100 in free money. That $2,100 a year invested at 8% over 20 years compounds to about $103,800 just from the match. not from your contributions, from the free money your employer was already handing you. Now here's the scenario that's actually happening for a lot of people watching this. You've got the credit card debt, you've got the car payment, things feel tight, and so you cut your 401k contribution from 6% down to 3% to free up $175 a month for debt payoff. That feels responsible. But what you just did is trade $175 a month in slightly faster debt payoff for roughly $51,900 in compounded free money over 20 years. That is not a good trade. That is the worst trade in personal finance, and it's the one being quietly implied by every piece of content that tells you to get out of debt before you invest, without running the actual numbers. So what's the right move? Here's where I want to give you something concrete, because this is the part that actually matters. You've got two realistic options, and I want to show you the difference between them in real dollars. Option A is the conventional wisdom version. You take everything you've got above your minimum payments, let's say that's $500 a month, and you throw it all at the debt. You pay off the credit card in about 18 months, then redirect that money to the car loan, and you're debt-free in roughly 3.5 years. Then you start investing $500 a month for the remaining 20 years at 8%, and you end up with about $282,500. Not bad. But during those 3.5 years, you captured zero employer match. At $2,100 a year in missed match money compounded out, that's somewhere around $63,000 you left on the table. Option B is the split. You contribute 6% to your 401k first, that's $350 a month, to capture the full employer match. Then you take the remaining $150 and put it toward the credit card. Your credit card payoff takes longer, about 48 months instead of 18, and you pay roughly $2,100 more in interest because of that. But your 401k balance from the match alone over 20 years grows to about $103,800. The net advantage of option B over option A, even after accounting for the extra interest you paid, is over $40,000 in total wealth. The honest punchline here is that paying off debt first at the cost of missing your employer match is mathematically the worst option available to you, and it's the one that sounds the most responsible. That gap between sounds right and is right is exactly where a lot of people in their 40s and 50s are quietly losing ground. Now, one more thing before I give you the actual framework to walk away with, because this part is worth knowing. The research on debt payoff actually shows something counterintuitive about how to structure it. A study published in the Journal of Marketing Research found that the strongest predictor of whether someone stayed debt-free after completing a payoff plan wasn't how much they paid, or the interest rate, or their income. It was whether they had completely closed individual accounts along the way. The psychological mechanism is account closure, getting a balance to zero, not just total dollars paid. What that means practically is that if you've got 4 debts, you're probably better off picking the smallest one and killing it completely before you split your extra money 3 ways. The math on which debt to pay first is one thing, but the behavior that actually keeps you on track is a different conversation entirely. So here's the framework. Write this down if you want something concrete. Step 1. Never, under any circumstances, contribute less than the amount required to get your full employer match. That is free money with a guaranteed 50 to 100% return before the market does anything. Nothing in your debt portfolio beats that. Step 2. If you're carrying credit card debt above 6%, and at 21% you definitely are, put every extra dollar above your minimum payments toward that balance, not split across everything. One balance as fast as possible until it's gone. Step 3. Once the credit card is cleared, look at your auto loan rate. If it's a new car at 6.37%, the math says investing the extra money beats early payoff by a significant margin. If it's a used car at 11%, that debt is worth paying down faster. Step 4. Once you've got the match captured and the high interest debt gone, increase your investment contributions. That's when you start building the actual wealth side of this. That's the honest version of this math. Not a clean starting point with cash sitting in an account, but the real version. With the car payment, the credit card, and the $500 a month of breathing room that most people actually have. If you've been waiting to start investing until you're debt-free, I want you to sit with this number, $40,000. That's roughly what the waiting is costing you, not because you're bad at money, but because the conventional wisdom on this topic skips the math. And now you've seen the math. If this kind of breakdown is useful, the real numbers, not the sanitized version, I've got a video on exactly how to structure your first investment contributions once you've got the match captured and the high interest debt under control. It walks through the same kind of real dollar framework built around what this audience actually looks like at 45 or 50, not a 25-year-old with nothing to lose. That one's worth watching next. And if something in this video matched your actual situation, the car loan, the credit card, the I know I should be doing more but I'm not sure where to start feeling, drop it in the comments. Tell me the number you're working with. I read them, and sometimes the best follow-up videos come directly from what people share there.